said, some of them we go into and it's like, hey, this is meant to just be a cash flow producing asset, and we'll see where it takes us down the line. Others, we go in and we say heavy value add, you still have a preferred return, but do not expect distributions every quarter because of the nature of the asset. But obviously there are some things that we're working on improving, some things we're trying to drive a little more for our investors within the portfolio. But by and large, I'm thrilled with the status of our portfolio, especially when you see what's going on in the real estate world more broadly.
Yeah, I'm against a pref that accrues, just because it takes, like, the purpose of an investor is to invest into the deal, and if it's successful, everyone wins. Welcome to Real Estate Hustlers Podcast. I'm your host, Josh Appleman. Today we're joined with Will Matheson. He's a co-founder of Matheson Capital, a Charleston-based firm with over $100 million in real estate acquisitions across the Southeast since 2018. Will, if you could, let the listeners know a little bit more about yourself.
Yeah, thank you for having me, Josh. So my company, I work with my twin brother, Evan, at Matheson Capital. We founded the company together, and we've been buying multifamily ever since 2018. Over that time, we've done about, call it 15 or so acquisitions totaling over $100 million. I've had 8 successful exits, average an LP IRR of, call it 35+%. And we're very fortunate to say that we do not have any floating rate debt hanging over our heads right now. So we're in a pretty good spot.
That's great. 35+% of IRR. That's incredible. So it tells me that you bought at the right time and you sold at the right time.
Yeah, we essentially sold almost all of our portfolio at the end of 21, beginning of 22. And we've been buying stuff back up using fixed rate debt ever since.
Got it. Well, let's go back to the beginnings. Tell us about your what got you into real estate, and then you. Yep, are you with me?
Yeah, I'm here. All right.
Okay, sorry. If we could, let's go back to the beginning. What got you into real estate, and then your first purchase, and so on and so forth.
So what got my brother and I into real estate? We do have some brokers in the family. I have a lot of family on my mom's side that's been involved with CBRE up in Canada. And my first job coming out of college was as a broker at Maximising. So that was, and also same with my brother. He ended up working with Maximising as well. So just first job out of college, doing real estate, had it in the family, some exposure on that end. And I mean, the first deal we ever did was actually while we were brokers. We had a client end up with, call it, $1 million shortfall on a split 1031 exchange. And they needed to find a hard money lender in, call it, a month. They couldn't get more proceeds. If they didn't close, they were going to have a big tax ramification. So our lead broker at the time, our boss, said, go find someone to do this hard money loan. And we thought to ourselves, well, we know the guy's schedule of real estate owned. We know roughly the net worth. We know their assets. So let's just put our first mortgage on one of his properties. We can raise the $1 million. And that was how we did our first ever deal. I guess we were 23 at the time. So that was how we got started. And then, our first actual acquisition we bought in January of 2018 with a classmate of ours from grad school. We bought a 2-unit deal in Los Angeles.
Got it. Okay.
Sold that 2 months later, made a nice profit.
So you did a flip. Will, are you with me?
Yeah, I'm with you. Yeah,
I think your audio is going in and out, but so that got you into doing a flip.
Yes.
Very cool. All right, so let's get into a larger deal. Tell us about one of your first larger acquisitions.
Our first larger acquisition. Oh, okay. So, I mean, it depends on, how many units do you want to break it down by? I mean, it wasn't in 2020, we bought called a $7 million deal. It was 69 units in Charlotte, North Carolina. That was a really big deal for us at the time, but April of 2022 was our first, call it fully staffed payroll property, 168 units in Greenville, North Carolina. Being honest, we bought it in April 2022. So you can guess by that timing, could have been a little more ideal, but we bought at a really nice basis. We had been coming off of a good 2021. So we had really strong investor demand for that. Rated it as very heavy value add. Still own it right now, going through a refinance where I'm pretty sure we're going to be able to cash out a good chunk of the equity for investors on that, which for an April 2022 acquisition I feel phenomenally good about. It's a property called The Avery in Greenville, North Carolina.
Oh, nice. I've got a 48 unit called Avery. So it's a good name, Avery Apartments.
Where is it? It's not in Greenville, is it?
No, it's Lawrenceburg, Indiana, just right outside of Cincinnati. So it's a good name though.
Apartment names get a little bit generic. I think we've all run into that.
100% for sure. It's whatever fits the timing and the area. So fully staffed property. So you've done your due diligence. You've closed it. You get in there, and do you introduce yourself to everybody? What does that look like?
We got underway with a pretty heavy value add program as soon as we bought the property. It was, how to say it? Since the time we bought it, I think the max collections at the time we purchased it were called $75,000 a month. And over the last 3 years, I think we hit our high water mark. We were right around, call it 140 a month. Yeah. So based on that, the unit count, you can tell it was pretty heavy value add. That was not meant to really be like a slow and steady, clip on Cooper, so to speak.
Got it. What kind of heavy value add? Are you interior, exterior, both? And then new roofs, new paint jobs, cosmetic? Is it structural?
So the answer to that is both. We've done some roofs, we've done paint, we've done a lot of interior renovations, called 60 to 80% interior renovations. Nothing quite as advanced as wiring or plumbing or anything like that. The property was 80s, 90s built. It wasn't, 60s construction or anything, although I am buying a 60s construction property right now. So that's something we're very, very fixated on in terms of how is the plumbing looking? Do we have aluminum wiring? Things like that.
Main thing is the Federal Pacific breaker boxes.
Yeah, well, I'll be honest. We had a little bit of a scare because, we looked at an original PCA. It says copper wiring. We do our analysis and we find aluminum and we see the pictures of it. And we're like, what is this? And I can't remember all the details, but it was essentially like, there's just this one really small section from here to here that's aluminum, and that's not uncommon. And so my heart skipped a beat there for a second because aluminum wiring kind of scares me at this point.
Yeah, and I would call the insurance on that. We bought a property that all of the breaker boxes in the units were changed over, but the mains coming in were still Federal Pacific. So one insurance company was good with it. The insurance company we went with, when they sent their inspector out, they were not good with it. So we're actually right now replacing all of those panels with breakers. And if an insurance company drops you, then you're pretty much against the wall. You have to go with the next quote or find a willing to carry the property.
Yeah, we were very proactive as soon as we said we saw that, and we were like getting on the phone, got to get a new electrician out there, see what's going on, explained it to our insurance people. It turned out to be it wasn't the most uncommon thing. Like, people had seen it before, and it's not like a full aluminum wiring build out or anything like that. It's just this very short section.
Got it. What attracts you all to that deal? The location, because the vintage is tough, but is it a great basis? The location's good.
Cash flow, I like the basis. Very high barrier to entry market. That property that I'm referencing is in Carborough, North Carolina, which is essentially Chapel Hill, North Carolina. Very high political barriers to entry. The county has very significant development restrictions. The demographics are phenomenal. Occupancy is very strong. Demand is very strong. It's part of the Research Triangle. So, that specific market tops literally, you Google fastest growing this, best jobs, standard of living, the triangle comes up all the time. And most importantly, my first apartment out of college was right next door. So it has sentimental value.
Yeah, for sure. That's and how many units?
168.
Yeah, it's got economies of scale. It's good size. That's cool. What are the amenities like? Just everything you can think of.
Yeah, just normal amenity
Yeah.
package, swimming pool, weight room, laundry, things like that.
What kind of debt are you taking out on it?
We're going to use fixed rate Freddie Mac debt.
Gotcha. Those are. We've got a couple that are agency debts. Just you get your IO, but you just can't do any kind of supplemental on top of it. So
I mean, if you're using the 5-year, then yeah, you're not going to get a supplemental. I mean, we've done a few loan assumptions with longer term debt, called 7+ years of term, and in those cases, we're like, oh yeah, we can explore a supplemental.
yeah, and that just explodes the returns when you can add something on top of it and still stay in a good position. What kind of rates are you getting out there?
I mean, the spreads on agency debt are give or take 150, 170, something like that today. I mean, obviously, it changes on a week-to-week basis because the treasuries are all over the place right now. So it's not the most enjoyable thing watching the 10-year every day.
Yeah, but you can't, you can't wait to buy real estate. It's buy real estate and wait is the thing, and just ride it out. So when you all buy a property, how's the property management set up? Are you all just asset management supporting the property management, or integrated?
We're not vertically integrated, so we try to pick the best property manager we can based on the market. I think we currently work with 4, soon to be 5 different property management companies. We work, yeah. So it depends on the asset. It depends on the asset class, the location, things like that. I mean, we currently own in North Carolina, Georgia, and Alabama. We sold our last remaining South Carolina property in December. And look, that's a big geographic range. Some of the properties are smaller, call it 20 units, 66 units. Some of them are 248 units. So each a different tool for every job.
Yeah, scattered sites are of course tougher to manage. You've got off-site staff, so you have a different caliber of a property management company to handle those, for sure. Cool. What are you all targeting? Is it just value add versus core?
So we really try to be opportunistic. Like right now, we're buying a value add. We're buying one value add deal. We're under contract on another value add deal. But prior to this, our most recent acquisition was 2022 construction BTR that we thought we were getting at a really good basis. The basis was good enough that we said, "Yep, let's go after it. Let's buy it."
Got it. Nice. And then, as far as capital, how are you all syndicating the equity?
It depends on the deal as well. So we have done, I want to say, 3 or 4 joint venture partnerships with private equity firms. We've also syndicated the majority of our equity on most deals. So it just depends. The one I'm buying right now in Carborough, that's a syndication. On some other deals, we're looking at them as like, hey, this seems like it would be a good joint venture because of, call it the check size, the vintage. On other ones, it's better to go with a syndicated route or JV or vice versa.
Got it. What has, in the past, what have you seen be most successful when you were selling off your portfolio, the structured equity structure?
Well, so, when we were getting started, I'm fairly upfront about this. When we were getting started in 2018, I was 25, 26 when we were buying stuff back then. No institutional group was going to hand us $5 million.
Right.
So we were syndicating all of our deals, doing really, really short-term holds. So it's like we would pitch investors on, hey, we want to sell this within 2 years of ownership. So all of the sales to date have been syndicated.
Retail investors, correct?
Yeah, just retail investors. So all syndicated retail investor type of deals. We actually did turn down an offer for a joint venture on the deal we sold in December of last year, specifically because they were going to want certain controls. Great group, we still talk, but they were going to want controls, minimum 3-year hold. And we said, nope, I want to be in and out. And we owned it for 14 months.
Yeah, smart move.
As far as what's been successful from a selling perspective, it's been the syndications because all the ones we've sold have been syndicated. But, we just had different, we started doing the joint ventures in 2022. So that's why.
Got it. Yeah, no, that makes sense. It's and then what about pref? Are you all paying out pref or no?
Preferred returns or pref equity?
Uh, Preferred returns, just monthly. To me,
Yeah.
it's a loan from the investor.
Yeah, no. So I think we're cash flowing on just about all of our properties right now. I mean, some of them, like I said, some of them we go into and it's like, hey, this is meant to just be a cash flow producing asset and we'll see where it takes us down the line. Others, we go in and we say heavy value add, you still have a preferred return, but do not expect distributions every quarter because of the nature of the asset. But obviously there are some things that we're working on improving, some things we're trying to drive a little more for our investors within the portfolio. But by and large, I'm thrilled with the status of our portfolio, especially when you see what's going on in the real estate world more broadly.
Yeah, I'm against a pref that accrues, just because it takes, like, the purpose of an investor is to invest into the deal, and if it's successful, everyone wins. But the pref, and I've got a property where we're paying out pref, but it's almost like just a loan payment out every month to the investors.
You do your distributions quarterly, or sorry, monthly.
Right, correct. We've got one deal that pays out monthly, and it's doing the deal is doing exactly what we underwrote it to do. So it's producing. It's a great deal. It was a great basis. But at the same time, you've got pref that you're paying out every month that is going to the investors. It has nothing to do with the performance of the property. It's a pref. So
Yeah, I
well,
mean, we don't structure a deal like that. That almost sounds like pref equity, not a preferred return to me. And we don't use pref equity.
it's just retail investors. There's preferred returns distributed every month, and it's above and beyond the split. So I mean, I guess it can be structured in any way, but that was what we went with at the time. But will I do it again? No. It's just one of those learning lessons that you learn how different structures work, which ones are successful, which ones are balanced the most, and take it from there.
Yeah, the monthly distributions we've heard people do those. We have not wanted to do that. The amount of reserves you have to bring to make sure you're constantly in that zone, I think, is pretty tough.
Yeah, I mean, this is a value add play though. We bought it at a great basis. Cash flow works, so I think every deal has to be unique to the capital stack and the structure too. Um, cool. Let's get on to growth and scalability. What are your all's next 3 to 5 years of growth look like on the horizon? What are your goals?
I mean, I feel so silly when I answer this question sometimes. I mean, my goals are generally more. I see some groups that, they buy their first property in 2022 and they already have 5,000 units, things like that. We're not the most aggressive buyer in the market. Although I do have a theory that every time a deal sells, one person says, man, that was really great. And everyone else says they overpaid. That's generally how I think people feel about it. But, we're trying to grow our portfolio. I think we've been net buyers all but 1 year since 2018. So, I don't have a number specifically. The goal is to grow.
Yeah, grow and be able to keep it. There's one thing getting there, but then keeping it is the other part. So it's and that comes from buying right. It comes from managing it right. But you can't. No matter what you do, if you buy it wrong, it doesn't matter what kind of management approach it comes with it. It can turn out to be a bad deal. Have you had any other people in your circle that have bought a property wrong and kind of see the fallout from that?
So, I mean, being in the industry, I've bought properties from people where they lost all their money.
Yeah.
I've been the buyer in those situations. I'm fortunate that I haven't been the seller in any of those situations, which I attribute to the fact that we've been a fixed rate borrower since we got started. I think there's one deal we did with floating rate debt, and that was because we closed in 36 days. But yeah, do I know people who've done it? Yeah, I know people who've really gotten wiped out and they bought wrong, operated wrong, used the wrong debt, things like that. We're just fortunate not to be one of them.
Yeah. Well, and that kind of came with them wanting 0 to 2,000 units overnight too. There was a very big buying spree and really no experience behind the scenes, or very little, and then a makeshift team put together.
Yeah, I mean, to that point, I mean, it's something I tell people too. I mean, we made a lot of mistakes in 2018 and 2019. Now, they were all profitable in the end, but there's a lot we didn't know. There's a lot you don't know that you don't know when you get started in the industry. And I like to think we've gotten better at our jobs over the years, more selective in terms of what we buy, where we buy, things like that. Even though we are also, this might seem like a contradiction, but we're buying in more markets and we're expanding.
Yeah, no, I call it paying ignorance tax because, like you just said, you don't know what you don't know. Which, if we pay the price today, then people around us don't have to pay the price tomorrow. Our families. Ignorance tax can be expensive, or it could just be cheap learning lessons. So, uh, but
Yeah, I mean, one of the things we told investors when we got started is, look, that we're going to try to do a short-term hold because if you wanted a 10-year coupon clipper, there's someone who's been in this industry a lot longer than me who's probably more qualified to give you that. We're going to try to get you a really nice profit in a short amount of time, 2 years. We would say we're asking you to date us, not marry us, because we're not asking for a 10-year commitment. We still don't ask for 10-year commitments.
yeah, no, and it's as you're building up the capital on the back end to be able to take down bigger deals, and then your track record and trust. 'Cause trust is built on performance. Then that time horizon might get longer because maybe you want to just build up cash flow and not necessarily just transactional income, and then a larger portfolio. So it just keeps coming with time too. Um, what kind of systems do you all use to stay organized and to build out your platform?
Yeah, I mean, in terms of, I mean, at the risk of sounding really, really boring, I mean, we use Archer for underwriting. I think Archer's a great service. It pulls great data. And it's a little more on the complicated side. InvestNext is our investor portal. HubSpot we use as a CRM. I know InvestNext can do both, but we bifurcate it a little bit. I'll be honest, I'm not the biggest technology guy. I'm not a systems obsessive. So I feel like I can never give a good answer to that question.
I'm with you. Technology definitely helps just be able to do more and track more. What about AI? What's your foresight on where that's heading and how that could affect the industry?
That will do things and impact things in ways that I cannot possibly fathom.
Yeah.
I'm not particularly great with AI. I'll be the first to say it. I was playing with it yesterday, just trying to make like a joke image of like a fictional football logo, and it took me forever to get it to do that. So not the best guy for AI. One of the things I do kind of wonder is if whether or not it's going to bifurcate the industry. Um, the teams, the groups that are going to be able to really invest into their own AI models, say Blackstone, they already are, they buy companies, not as much assets anymore because they're already so big. So to what extent how to phrase it, are we still going to see like a middle market that's somewhat removed from AI because any of the groups that can build their own AI models and target this, that, and the other properties, they just don't want to write the checks that are small. They don't want to write the $10 million check. They want the 15, the 20, the $25 million check. I mean, we've seen massive improvements in the efficiency of apartments, not due to AI per se, more due to like not the rent-seeking algorithms, the daily pricing models that are now involved in the lawsuits. We've seen, but you could look at that as becoming more efficient. But I just, generally speaking, on AI, I'm not sure. I'm not sure how I think it'll impact things. It'll impact them. I just don't know how.
Yeah, I think it's like more on a tenant basis because ultimately conversational AI is being developed better and better every day. And those conversational AIs turn into bots. Bots take jobs more than anything. If it's a communication standpoint, taking care of a service ticket or calling in and communicate, complaint, whatever, what have you, those frontline positions are what I think are going to be most impacted within the next 2 to 3 years. And then what does that look like for the workforce going to go get a job, and what skills do they then bring to the table to acquire a job that something that's been built on AI can't do? So think it's diving deep and staying kind of on the forefront of what's out there, even available, not even being developed, or not even what we don't know is being developed. It's huge. It's going to be a massive thing. We'll see.
Yeah, no, we'll see. I mean, that's what is it? The only constant is change, so to speak.
Yeah. I mean, for sure. Cool. Leadership and insight. What would be the most pivotal moment that you've had so far since 2018?
Since 2018, most pivotal moment we've had. I mean, every time you do a new acquisition, it seems like it was the biggest deal you've ever done. Anytime you sell a property, it seems like it was the biggest deal you've ever done. I'll take that in a little bit of a different direction. I mean, we have one real dud on our resume, property called Greenwood Village Townhomes. We bought it in Charlotte, December 2019, seemingly a really great time to buy. But with COVID, the eviction moratorium, everything went wrong with that property. We were able to package it with another asset we owned, sell it, and we barely made any profit. I mean, we didn't lose money. It was call it break even plus.
You preserve capital, though.
We preserve capital. We've never lost any investor money, and I look at that as kind of a way to say, I mean, that was a pivotal moment getting through that deal. We owned it for, I don't know, call it 28 months, but learned a lot of lessons on that deal. There's a little bit of a bifurcation in our track record between our 18 and 19 acquisitions and then everything beyond that.
Yeah, I think, well, you're not alone there neither, because that was you had interest rates that kept on climbing. You had deals that were being sold at future, if you do this, then you can get that valuation. So there's a lot of just different crazy things happening. And it is still out there. Actually, it really is out there with purchasing brokers sending out deals that are this property down the road's doing this, so this property is worth that, and it's just not the case.
Yeah, I saw a deal recently where it was like, oh yeah, it's a real value add deal. You can, if you just turn over every single tenant and cut the existing expenses and you can get it to a 7 cap. Mind you, not like a 7% yield on cost, even just like a 7 cap. I'm like, I don't know what to do with that.
Yeah, and that's neutral leverage with interest rates the way they are right now. I mean, you're not. A lot of these are going into negative leverage if you let them, but we'll see. I think the market still we've got some ways to go. But so how do you stay sharp? Mentors, masterminds, groups. How do you stay relevant out there?
I mean, I'm not in any masterminds. I mean, I'm not really involved in a lot of groups. I work with some people who've been in the industry for 30, 40 plus years, in some cases longer than I've been alive. They're investors of ours. You can call them mentors. That's been incredibly helpful. Like I said, there's just sometimes you don't know what you don't know. We have a group of some investors will take deals too early, ask them about that. But, I'm not a big groups guy, to be honest with you.
Yeah. Got it. That works. Okay. What advice would you give someone scaling to their first $50 million in assets under management?
I mean, if your goal is to get to the $50 million, I would say start small. I know that some people do it where they'll buy their first deal and they'll raise $10 million on it. I don't know how people do that, to be totally honest. I mean, you've got to have the greatest Rolodex in the world to do something like that. But we started small because we didn't think we would be able to raise significant chunks of money. If you start small, the market's typically less efficient. Your CapEx numbers will probably be more impactful. The loans are easier to qualify for. The equity raises are smaller. Just start small, do short-term holds, build the track record, get some happy investors. Part of the reason we did what we did was because we said, it's going to look a lot better if we have a bunch of full cycle deals as opposed to saying, yeah, I've made my quarterly distributions the last 3 years. Not that there's anything wrong with that, but when we were getting started, I just wanted to show, boom, 40% IRR to my investors. Next deal, next deal, next deal.
Very cool. Very good advice. Start small, get the experience, get the learning lessons out. Learning lessons are smaller if the deal is smaller. The bigger the deal, the bigger the learning lessons could be. So it's great advice. Very cool. Will, if somebody wants to get a hold of you, reach out to you, learn more about yourself and your firm, how can they get in touch?
So the best way to get in touch with us, you can go to our website, which is mathcap.com, mathcap.com. I should have put it in my name like you. That's my bad. This is why you're the host and I'm the guest. You're the real pro. I'm also easy to find on LinkedIn, Will Matheson, Matheson Capital, LinkedIn, pretty easy to find. I tend to post there multiple times a week, so shouldn't be hard to find.
Awesome. Will, I definitely appreciate your time and look forward to following you. Thank you.
Thank you.